Hello everyone and welcome to the YouTube channel of BeingACCA. This is Tushita Gupta, ACCA affiliate, and in this video we are going to be solving section A questions from the topic working capital management. So let's get started. Thrifty company's cash budget highlights a short-term surplus in the near future. So there's going to be a surplus, that means there's going to be extra cash in their hand. Which of the following actions would be appropriate to make use of the surplus? So either they can pay suppliers early to take advantage of any prompt payment discounts, buy back the company's shares, increase the payables by delaying payment to suppliers, or invest in long term deposit bank account. So basically, when we talk about buying back and depositing long term, these are both something that the company can do in the long run. This is not something that they can do in the short run. It is mentioned over here that this is a short term surplus, so that is why B and D get eliminated. Now when we talk about C is basically about delaying the payment. So when we have surplus cash, why would we delay the payment? We would rather take advantage of the prompt payment discounts so that we save on some money also. So that is why option A is your answer. Moving on, indicate by clicking in the relevant boxes true or false. Okay, working capital should increase as sales increase. Definitely yes, because what happens is if your sales revenue is going up, that means you're going to be, having to invest more in your inventory, and because you are going to satisfy a lot of more demand because of the increased sales. So that is why you will have to increase your working capital with the increase in your sales. An increase in the cash operating cycle will lead to an increase in the working capital funding costs. Now this is also true, because what will happen is if your operating cycle is getting more lengthy, this will lead to more cash being out of the business for longer, and more funding will therefore be needed, right? Because when your operating cycle is increasing, that means cash is not remaining in your hands for a longer time, and that means the working capital funding cost will also increase because you will need to borrow more, so more funding will be needed. Now over trading is also known as undercapitalization. That is true. So basically, if you define overtrading, it is where the business is not having enough cash to sustain the level of activity that is it is currently trading at. So all of these statements over here are true. Which of the following might be associated with a shortening working capital cycle? So we have to say that which will shorten the working capital cycle. So let's have a look at the options. Lower net operating cash flow. So this will basically be lengthening your cycle because your cash flow will be lesser, so that means more time will be taken to complete one cycle. Then increasing tax allowable depreciation expenditure. Now, depreciation cannot really impact your working capital cycle because depreciation is a non cash expense. Now, let's talk about slower inventory turnover. Now, if your inventory is being sold slowly, that again means your working capital cycle is lengthening. You are taking more time to complete one cycle of your business. Then, taking longer to pay suppliers, definitely yes, this will shorten your working capital cycle because cash will stay with you for a longer period of time, right? Because you are taking you are delaying the payment to the suppliers, that means you are keeping the cash with yourself for a longer period of time. Moving on, we have to calculate the length of the working capital cycle. So basically, what we do, the formula classic remains that your cash operating cycle or your working capital cycle will be receivables collection period plus your inventory holding period and subtracting your payables payment period. So basically, you add all the assets and deduct all the liabilities time periods. So with this, raw material is our asset, so I'm going to be adding the raw materials, which is 6 weeks, and then With regards to payables, I can see that this is my trade payables I know are a liability, so -7. Then for production, work in progress, it is 2 weeks, so again it is my asset. Work in progress is my asset, so I'm going to add that. Then again, finished goods are again my assets, so I'm going to add that as well. And then the last thing that we have left over here is our trade receivables. So basically receivables are my asset again, so they will be added. So with this I will arrive at my final answer, which will be 17 weeks, and I will mention the same over here. So this is question 56, right? Moving on. A company sells inventory for cash to a customer at a selling price which is below the cost of the inventory items. How will this transaction affect the current ratio and the quick ratio immediately after the transaction? Indicate by clicking in the relevant boxes whether each ratio will increase or decrease. So, whenever we have to find out an increase or a decrease, we should, take values assumptions so that we are able to calculate the effect properly. So over here, let's first talk about current ratio. So this is question 57. We know that current ratio will always be equal to your current assets divided by current liabilities. So current assets divided by current liabilities, right? This is our formula. So when let's talk about this transaction. The company is selling inventory for cash to a customer at a selling price which is below the cost of the inventory items. So let's assume the idle ratio. Let's suppose our current assets are 20,000 and our current liabilities are 10,000. So that means right now my ratio is 2:1. So this is my ratio at the moment. Then with this transaction, let's suppose I am selling inventory for cash to a customer. So basically, with regards to my current assets, I am going to be selling off something. So let's suppose I sold off something. It is also mentioned that the selling price is below the cost of the inventory items. So I would be holding my item at the cost, and now I'm selling it below the cost. So that means, let's suppose I had an item of $100, and then I'm selling it at $50. So in that case, my current assets will be this amount. The value is 100 as per my records, and then I'm selling it for 50, for which I'm receiving cash. So my current assets are reducing by 100, which is the inventory value, and then I'm going to add what is going to be my cash that I'm going to be receiving. So this is going to be my new current assets, and then nothing is happening with the denominator, that is our liabilities. So this remains the same. So if I find out how much is my current ratio now, it has decreased. So I will tick decrease over here. Then let's talk about the quick ratio. So with regards to the quick ratio only includes your current assets excluding inventory. So the formula for that is current assets minus inventory, and that is divided by current liabilities, right? This is the formula. And then again, let's assume your ideal ratio. Let's suppose it's 1:1. So I'm taking 10,000 and 10,000 as my current liabilities as well as my quick assets or my liquid assets. So in this scenario, again, when I'm selling inventory for cash, now what will happen is inventory is already excluded. So I just need to account for the cash that is coming in. So my cash that was, I will go with the previous example. I had $50 of cash that was coming in. So I'm just going to add 50. Inventory is already excluded over here, so I don't need to do anything about it. Now again, my denominator is not changing. So earlier my ratio was 1:1, and now my ratio has slightly increased. So that is why I will put a tick on increase. Moving on, a company has the following summarized statement of financial position at this date. Over the next year, the company should double its sales. The company does not plan to invest in any new non current assets, but inventories, payables, receivables should all move in line with the sales. What cash balance in 1 year's time would this imply if the non current assets were all land, no new capital was raised, and all profits were paid out as dividends? So basically, when we say that there is no new capital and all profits are paid out as dividends, so that means we do not have any retained earnings also. So the fact that we have given 1250 worth of total over here, this will not change. So the cash balance will therefore be a balancing figure to maintain this total. So again, it told that all the non-current assets are land, which means they will not be depreciated. So if I just have a look at what the values will be next year. So next year also my 1000 will remain the same because all of these are land and no depreciation is charged on land. Then with regards to inventories, it is said over here that sales will double, and inventories, receivables, payables all will move in line with the sales. So I can say that my inventories will now come out to be how much? Double of what they are now. So they are 200 now and multiplied by 2. So this will be the new figure of inventories. Now let's talk about receivables. Again, receivables will also double. So with regards to that, it is 150 at the moment, and next year it will double to 300. Then we have our item as cash, which will be a balancing figure. So I'm just going to put nothing over there as of now. Then we have our current liabilities, payables. Again, this will be doubling with the sales. So we will have payables again of $400. Um, I can just create a rough sheet over here. So, right. So the first thing that we have over here is our non-current assets, and non-current assets are the same. They're going like no change because it's all land. Then we have our current assets, inventory, receivable, and then cash. So I am putting cash over here as 0 because it's going to be a balancing figure. So with this, I will have the difference over here. If I just like total up my current assets, so my current assets are going to be 700, and then let me mention this over here as well. So this is going to be my current assets. And then if we talk about our current liabilities, so first figure that we have over here is our payables. So payables are coming out to be 400, which was 200 multiplied by 2. And we also know that our net current assets are going to remain the same, right? So net current assets is going to be 250. So basically, what I can say is that the difference between my current assets and my current liabilities is going to be 250. So I can see that the total over here is 700, and as of now, this is 400 only over here. That means I am getting a negative 50 as a balancing figure for my overdraft over here. That means I have taken extra money. That is why I have more assets. So this will be 50, and then I will find out how much my cash is going to be. So my cash is nothing in positive. That means I have a $50,000 overdraft, which is option C over here. Then Gold Star has an accounts receivable turnover of 10.5 times, inventory of 4 times, and payables turnover of 8 times. We have to find out what is the cash operating cycle in days. So basically what we'll do over here is we already have it in times with us. Now we just have to convert it into days. So this is question number 59. We know that the cash operating cycle will be receivables plus inventory minus your payables. So basically, if you find out the period for receivables, it is going to be so it is mentioned we have to assume 365 days. So I can just divide 365 by the ratio that they have, which is 10.5, and this will give me my days for receivables. Similarly, I will work it out for inventory. So inventory is again going to be 365 divided by 4, and then I have my payables. So my payables will be 365 divided by 8 times is the figure given over here. This is my payable days. So with this I can put the formula receivables plus inventory and minus your payable days. So with this you have your answer as 80.38. We have to round it off to the nearest day, so I will write 80 over here. Moving on to the next question. The cash operating cycle is equal to, so we just have to select the formula over here. The formula is receivables plus inventory and minus your payment period. So option A is the correct one. Moving on. A company has an annual credit sales of $27 million and related cost of sales of $15 million. These are their targets. Now we have to find out how much is the investment that they are going to be needing in the next year. So if we work out the calculations over here, this is question number 61. So we have to find out first of all how much investment we are going to be needing in our inventory. So with regards to inventory, I can see that my inventory holding period is nothing but 60 days. So 60 by 360 is the figure for inventory days. And then on which figure will I be basing my inventory? Inventory will always be based on cost of sales. So this is $15 million. So right. With this, I know that this is going to be the working capital investment that I'm going to be needing in my inventory. Then, if I talk about my receivables have a time period of 50 days. So, 50 divided by 360. I'm taking 360 because it is mentioned over here that we have to assume 360 days in a year. Then, I will multiply again. The trade receivables will be based upon your sales. So, 27. Right. So this is the investment working capital money that I will be needing with regards to my receivables. Now let's talk about the payables. So with regards to the payables, I can see that the days are 45. So 45 divided by 360, and then I will multiply that. Receivables will again, your payables will be based on your cost of sales because it is your suppliers, and suppliers are giving you the raw materials which form a part of your cost of sales. So your investment that will be required will be inventory plus your receivables and minus your payables. So this is the investment that will be needed in your next year. This is option B. Moving on, a cash budget has been drawn up. We have to find out the closing cash balance for December. So we can see over here that we have receipts. The total, if I do over here, this will be 30,000. Then with regards to the payments, we have 13,000, 3,000, and this is the opening cash balance as well. So let's work it out over here. This is question 62. If I just add up my receipts, total receipts will be 20,000 plus 10,000. And if I total my payments, that will be 13,000 plus 4,600 plus 3,000. So this is my total payments. Right? So my net cash flow in this time period will be the difference between these two. This is going to be my net cash. And in the beginning, I also had 500 opening cash. So that means my closing cash will be the sum of both these. So this is my closing cash. Right now, in the next period again, so this was for October. Now, if we work it out for November, so for November, my receipts are 11,000 plus 4,500. And then for payments, I have 4,200, then 2,300, and then 1,750. 1,750. So this is the total of my payments. And if I again take out the difference, I can copy paste the formula over here. So this is my difference. And then my opening cash was the closing cash of the previous month. So this was my opening cash for the month of November, and I can just copy paste the formula over here to work out my closing for November also. So now I will work it out for December. So for December, I have total receipts of 14,500 plus 6,000. And then I have payments of 7,800 plus 3,000 plus 1,900. So this is my total of payments. Now I can copy paste this formula over here. This is my net cash for December. Then I have my opening cash, and then the sum of both of these is going to be my closing balance at the end of December. So this will be 29,450 deposit. Deposit means that, sorry, it's option D, my bad. So deposit means that it is a positive balance and it is not any overdraft. Then question 63 now, which two of the following would be key aspects of a company's accounts receivable credit policy? So receivable, whenever we are giving something on credit, we will obviously assess their credit worthiness. Then checking credit limits once a year, no, this will actually depend from company to company. Invoicing promptly and collecting overdue debts, definitely yes, because the more delay that you cause in issuing an invoice, the more delayed will the payment be. So definitely you will invoice promptly so that the receivables pay up on time. Then a company is preparing its cash flow forecast for the next financial period. Which three of the following items will be included in the calculations? So definitely your corporation tax is an outflow which you need to account for. So this will be considered. A dividend receipt from a short term investment, again yes, this will add to your cash flows. Loss made on disposal, no, this is a non cash item. Bad debt written off, again this is a non cash item. An increase in a provision, again this is a non cash item. The receipt of funding from the purchase of a new vehicle, yes, this is something that is cash based, so this will be considered. So your answers are A, B and F. For a retailer, these are the figures, which is the best expression for accounts receivable collection period. So, with regards to our receivables, so the closing receivables collection period will be equal to your closing receivables balance divided by sales into 365. So, if I check over here, option C matches. It is about receivables, which is divided by your sales and then multiplied by 365. Moving on, which of the following is not usually associated with overtrading? So, overtrading will basically lead to your higher inventory, higher receivables and payables, and this will, increase your current ratio in the short term, and over the long term, this will be causing you liquidity issues. So, what it will not be associated with increase in current ratio? This is something that will not happen. There will be a rapid increase in revenue, there will be an increase in the volume of current assets, and there will be increase that will be financed by credit, because you do not really have the money, but because you are over trading, you are getting credit and then you are buying more assets with that money. So increase in the current ratio is something that will not happen. Moving on, generally, increasing accounts payable payment period suggests advantage is being taken of available credit, but there are risks involved. Which of the following is unlikely to be one of the risks involved in increasing the accounts payable payment period? So, when we talk about increasing the payable payment period, that means we are, we may be losing goodwill, we may be losing the prompt payment discounts, and the suppliers will also increase the prices to compensate for the fact that we pay late. So basically our bargaining power will also fall. So this is unlikely that our bargaining power will increase. Moving on, which two of the following are aims of a just in time inventory control system? So reduction in capital tied up inventory, definitely yes. This is one of the major aims of JIT. Then a creation of inflexible no. Elimination of all activities performed that do not add value. Yes, this is one of the fundamental principles of JIT, that it aims to eliminate all activities which are not of use or which are not adding any value. Then moving on, although cash needs to be invested to earn returns, businesses need to keep a certain amount readily available. Now, which two of the following are reasons for holding cash? We have studied this. This is transactions and precautionary. The other two are not the motives that are there to hold cash. Andrew Company is a large listed company financed by both equity and debt. In which of the following areas of financial management will the impact of working capital management be the smallest? So, liquidity again will have an impact, interest rate management will have an impact, management of relationship with the bank will also be impacted. Dividend policy is something which will not be impacted by the working capital management. Then Crag Company has sales of $200 million per year and the gross profit margin is 40%. Finished goods inventory holding period varies throughout the year. So this is the range. Maximum it is 120 days and minimum it is 90 days. All purchases and sales are made on cash basis and no inventory of raw material or work in progress is carried. Crag Company intends to finance permanent current assets with equity and fluctuating current assets with its overdraft. In relation to finished goods inventory holding inventory and assuming a 360-day year, how much finance will be needed from the overdraft? So we have to work out a calculation over here. So basically we say that 90 days is the minimum holding period. So this is the something which we can say is the permanent asset. This is something which remains always. So this will be financed with the equity. Now the fluctuating part, which is 120 minus 90, which is 30, this will be financed by your overdraft. So the annual cost of inventory, if we see over here, let's work out the calculation. This is question 71. So the annual cost of inventory, if we see, is basically $200 million, which is the sales, multiplied by how much is your margin? It is 40%. That means my cost, if I find out the cost of inventory, this will be 60%, because 40% is the profit. So 100 minus 40 is 60% is going to be my cost. So that means $120 million is my cost. Now I have to find out how much finance we will need from the overdraft. So as we just discussed, overdraft is something which we need only for 30 days. 90 days will be financed with equity because this is permanent, and the difference, which is 120 minus 90, so the difference of 120 minus 90, these many days will be financed by the overdraft. So this multiplied by this is in days, so 30 divided by the total days are supposed to be 360. So this is going to be my answer. $10 million is something that I will be financing from my overdraft. Right. Moving on to the next one. Pop company is switching from using mainly long-term fixed rate finance to fund its working capital to using mainly short-term variable rate finance. Now we have to tell the impact on the working capital financing. So finance cost, when you go for long-term fixed to short-term, usually the short-term finance is cheaper than the long-term finance. So your finance cost will decrease. Refinancing risk, now this will increase. Why? Because when you are working on a basis that your finance is short term, that means time and again you will have to renew that finance, so refinancing risk is more over here. Then interest rate risk, there will be no change with regards to that. And then if we talk about overcapitalization, again no change with regards to that. Which of the following is an advantage of implementing a JIT inventory management? Quality control costs will be eliminated, no. Monthly finance costs incurred in holding inventory will be kept constant, no. The frequency of raw material deliveries is reduced, no. It is actually this, that the amount of the obsolete inventory will be minimized. Why? Because when you talk about JIT, obsolete inventory is lesser because you are producing right at the moment, just a few moments before it is being demanded, so there are lesser chances of being obsolete. Then Dev Company is a large multinational company which expects to have $10 million cash deficit in 1 month's time. The deficit is expected to last no more than 2 months. Dev Company wishes to resolve its short-term liquidity problem by issuing an appropriate instrument on the money market. So, which of the following instruments should the company issue? So, we see over here that it is going to be a short-term thing, so we are going to have a money market instrument, and they want to resolve this problem by issuing appropriate instrument. So basically they will be issuing over here a commercial paper. Why? Because commercial paper can be issued at a discount and then it will be repaid at the nominal value. It is short term again, which meets the company's needs. And if we talk about loan notes, they are for long term. Treasury bills are issued by governments and not companies. And if we talk about futures, it is not really, we are not supposed to be hedging the interest rate risk over here. We are in need of money, so futures will not be able to serve our purpose. Moving on, Mile Company is looking to change its working capital policy to match the industry. So these are the expected results. The requirement over here is that we have to find out if Mile Company matches its working capital cycle with the industry, what will be the decrease in its net working capital. So we have the figures also given to us, 50, 42, 45, 35, 40 and 35. So basically what we see over here is we have to match the industry. So in order to match the industry, what we'll have to do is, currently our receivable period is more and industry is less, so we are going to have to reduce the receivables period. So talking about receivables, with regards to that, how much is the difference? So the difference is 50 minus 42, which is 8, and I will divide that by 365, that is the number of days that we are supposed to take, and then I will multiply this by my my revenue, because revenue is something on which the receivables are based, right? So this is going to be my decrease in the receivables. Then if I talk about my inventory days are also more than the industry. It is more by 10 days, so 10 divided by 365 and then multiplied by the cost of sales, which is 12,800. Right. So this is going to be my decrease in the inventory. Then talking about payables again, I can see that this is more than the industry. Industry is 35 and minus 40, so 5 is the difference, divided by 365 and then again multiplying this by my cost of sales, which is 12,800. Right, so this is going to be my reduction in the payables. Now total, if I find out how much is going to be my reduction, so all of this is reduction, so my signs are going to be opposite. We used to add receivables and inventory, over here they will be subtracted. So minus this and then minus payables will become plus payables. So this is going to be my net decrease. So net decrease is going to be option A, right? Swap company is due to receive goods costing this much. The terms of trade state that the payment must be received within 3 months. However, a discount of 1.5% will be given for payment within 1 month. Now we have to find out what is the annual percentage cost of ignoring the discount and paying within 3 months. So this is question number 76. First of all, we see over here that if the discount is accepted, how much the company is going to be paying. So the company is going to be paying 2500 multiplied by 1.5% is the discount, so 100% minus 1.5%. So this is going to be the amount that we will be going to pay if the discount is accepted. Now if the if we pay after 1 month, we can pay this money by borrowing also. And how much will be the cost of borrowing? So within 3 months, and a discount of 1.5% will be given. So alternatively, the company can effectively borrow this much amount of money for an additional 2 months at a cost of $37.5. So what we can say over here is, so basically 37.5 is nothing but the difference between these two figures. So the effective rate, if I find out, so the 2 months rate, if we see, is this figure divided by this figure multiplied by 100. So this is the rate for uh, 2 months, right? Now we have to make it for a year. So what the formula we can use is that, the easier way to approach this will be 1 plus the discount divided by your amount left to pay, raising it to the power 12 divided by the number of months that we are saving. So we are saving 2 months because earlier we would be paying within 3 months, now we are paying within 1 month. So basically this is 1 plus 1.5, which is the discount, divided by amount left to pay will be 98.5. And then I close this bracket and I raise this entire thing to um 12, which is the total number of months, and then dividing by the months saved, which is 3 minus 1, which is 2. And with this I will have my, if I just subtract 1 from it, I will have my percentage. So my percentage will be 9.49%, which is option D. Moving on, will company incurs cost of $65 every time it places an order with its raw material supplier? It orders 300,000 units of product each year. The cost of holding 1 unit of inventory for a month is 2.5. Buffer inventory is 25,000 units of material. So we have to find out the EOQ over here. So basically, when we talk about EOQ, we do not really need buffer inventory. So we'll just be using the formula of EOQ. This is question 77. So EOQ is nothing but, I will put the square root later. So 2 multiplied by my annual demand is 300,000 units. And then I will multiply this by my ordering cost, which is 65. And then I will divide this figure by my holding cost, and holding costs are given to be 30. So now if I just take a square root of this figure, right, so this is going to be my EOQ, and we have to round it off to nearest 10 units, so it will be nothing but 1140. Moving on, which two of the following are statements true about the cash management models? So, the Baumol model is more suitable when cash flows are steady and predictable. So, yes, this statement is true because it will be more, the assumption that the Baumol model takes is that, the flows are steady and predictable. So if this is actually the case, the Baumol model will be more suitable. Then let's talk about, both models assume that cash is either held in a current account or long term investments. No, that's not right. Miller or model, the upper limit of the current balance is set by management. No. Then both models take into account transaction costs of switching between current accounts and investments. This is absolutely true. Okay, question 79 now. A company has erratic daily cash movements with a standard deviation of $3,000 per day. It costs $25 to move cash between current account and its short-term deposit account. The deposit account earns an interest rate of 7.3% per year, and there are 365 days in 1 year. So we have to calculate the spread over here. The spread formula is also given in your formula sheet in the exam, so you do not need to worry about learning remaining the same. So just putting out the variables over here. So my transaction cost is given to me. Transaction cost is $25. Then I have my standard deviation given over here, but in the formula I need my variance. So variance will be nothing but the square of my standard deviation. So this will be 3000 squared, and I can just multiply this by 3000 again. So this is my variance. And with regards to my interest rate is given as 7.3% per year, and now I need it for per day. So I will just divide that by 365 days. So this is my interest rate also now. So with regards to the formula of the spread, I'm going to be using the second half first. So this is 3 by 4 multiplied by my transaction cost, and then again multiplying this by my variance, and then dividing this by my interest, and then raising it entirely to 1 by 3. So this is my first part of the formula. Now I just have to multiply this by 3 to find out my spread. So 28,348 is my spread. I have to take it to the nearest thousand. So the nearest thousand will be 28,000. So my answer over here will be input as $28,000. A company has sales revenue of $30 million and its customer take an average of 75 days to pay. They offer 1% discount to customers who pay in 30 days. So we have to calculate the new anticipated receivables if 60% of customers take up the offer of the discount and rest carry on to pay in 75 days only. We have 360 days in 1 year. So basically we will first work out our receivable balance, and then we'll work out how much will be the anticipated receivables balance. So this is question number 80. We have customers who will not be taking the discount and will continue to pay in 75 days. So for that, my receivables are going to be 75, which is the number of days, multiplied by 30 million, which is my revenue, and then I will take 40% again, 40%, and I will divide this figure by 360, which is the number of days. So this is going to be my receivables. So I can just put in the zeros over here so that I also have the correct figures in thousand terms. So 2.5 million is going to be my receivables, and then for the customers who take the discount and will be paying in 30 days, and they will be given a discount of 1% as well. So with that, my receivables are going to be over here. 30 is the number of days that they will be taking, dividing that by 360, and then multiplying this by 30 million, which is my receivables. And then I will have 60%, because that's the number of people that are going to be taking the discount. So I forgot to also put it as 99%, because they will be getting a 1% discount. So this is the amount of money that I will be receiving from them. So my total receivables balance will be the sum of both these figures. This is my new receivables balance. Now we have to ignore the discount taken for those people who are you know those who are taking the discount. So for that, if I just do not put I will just copy this over here, and if I do not take 99%, this is the whole value. So this will be the total. So in that case, my new receivables will be this plus this, and this is going to be my new receivables balance, which will come out to be 4 million. So 4,000,000 will be the nearest, right? Which of the following is or are true? So a conservative working capital investment policy implies higher proportion of permanent current assets to fluctuating assets. No, in fact it's the opposite. Then long term finance is generally cheaper. No, we just discussed above that short term finance is generally cheaper. Moving on, which of the following statements is consistent with an aggressive working capital funding policy? Most current assets are financed with long term. No, aggressive will minimize long term. So let's talk about statement B. Most current assets are funded with debt rather than equity. No, this is also wrong. Then the third statement says most current assets are financed with short term funding rather than long term funding despite the higher risk involved. Now this is absolutely consistent with the aggressive funding strategy. Moving on, two companies A and B have the following average levels of working capital. We have to identify which type of strategy they are employing. So, with regards to a company, I can see that there are 4 million working capital which is financed with long term debt. So, usually the minimum that they have is 6 and the maximum that they have is 10. So, despite the fact that minimum is 6, they are still only taking 4 million from long term. That is why they are following an aggressive strategy, right? Then, for with regards to B company, they have $9 million in long term debt, and minimum is 9 only that they are needing. So they are matching up with the uh, how much is the minimum needed and how much they are financing from their long term capital. So this is it about question 83. Which of the following is or are true? An aggressive working capital funding policy implies a lower value of current assets and a higher value of current liabilities than a conservative working capital funding policy. No, this is not right. Then a long term debt finance is riskier for the lender rather than short term finance. Definitely, yes. When you are giving your money to someone for a longer period of time, then that automatically means that your there are more chances that the person will run away or will not pay up your money. So this is option B. The inventory ordering policy of ZAR company is to order 100,000 units when inventory level falls to 20,000 units. The cost of placing and processing the order is $200 while holding is zero point 0.5 per unit per year. Orders are received 1 week after being placed with the supplier, and the production requirement for the next year is 600,000 units. So we have to find out what is the cost of inventory ordering policy. So let's solve this over here. This is question number 85. So I can see over here that my ordering cost over here is $200. Then my holding cost is zero point 0.5, and then my annual demand that I can see is 600,000 units, and then my order quantity is 100,000 units. Just let me label these: holding, and then this is annual demand, and then this is my order quantity, right? So over here I have to find out my annual inventory cost. So first of all, my ordering cost. So ordering cost is going to be, the annual demand that we have is 600,000, and in once we are ordering 100,000. That means we are placing 6 orders every year, and the cost of one order is 200. So that means 1200 per year is my ordering cost. Then with regards to my holding cost, I will take holding. So with regards to that, my holding is going to be first of all taking the average of my order and then adding the buffer inventory to the same, which is 8,000 units, and then I will multiply this by 10. How much is my holding cost, which is 0 0.5. So this is my holding cost, and with this I have the holding as well. And now I will be totaling both of these up to find out my inventory ordering policy cost. So this will be 30,200. So I'll just mention this over here. Then for the coming year, a company has budgeted sales of $2 million per month, 80% of which will be on credit, and then it expects its accounts receivable payment period to be 3 months. Forecast average inventory and average accounts payable for the coming year are 10 million and 4 million respectively. We have to find out the working capital requirement. So the working capital requirement is simple over here. First of all, we have to find out how much our sales are going to be. So let's put over here, this is question 86. With regards to my credit sales, so my credit sales will be 2 million. 2 million multiplied by 12, because 2 million it's per month, and then 80% is my credit sales. So this is going to be my credit sales in total. Then to find out my receivables, so my receivables will be it's mentioned that it expects accounts receivable payment to be 3 months. So this is 3 by 12, and then multiplying this by my sales, credit sales. So this is the receivables that I'm going to be having. Now there is no mention of cash over here, so I'm ignoring that in the calculation. Then how much my working capital requirement is going to be? First of all, I add my inventory, then I add my receivables, and then I subtract my payables. Payables are 4. So $10.8 million is going to be my working capital requirement. Then let's talk about which two of the following are correct descriptions of net working capital. So net working capital will always be current assets minus your current liabilities, and another option is that how much long term that you are investing in your net current assets. Moving on to the last one for this topic, we have to match in which policy what will be there. So relatively high level of current assets you will find in a conservative policy. Then relatively low level of current assets again you will find in an aggressive in an aggressive investment strategy. Right. So low level of current assets you will always find in an aggressive investment strategy. Then relatively large amount of short term finance. Again, when you are aggressively financing yourself, you will be going for large amounts of short term finance. And then relatively small amount of short term finance, this you will find in your conservative financing policy. With this we have come to an end to this topic of working capital, and in the next video we'll discuss about investment appraisal. Thank you so much for watching.